With the S&P 500 hitting yet another record high, the question you might now be wondering is, how much higher can the market go? Should I buy now and ride the wave up? Or is there a bubble on the horizon which will crash the stock market? So let's talk about that in this video. Also, do join my 9,000 members Telegram chat group to discuss or ask any questions that you might have. For a while now, analysts have been warning that the stock market will eventually pop and send the stock market 18 levels underground. For example, the S&P 500 could crater 48%. Brace for the inevitable market crash. Bubble of all bubbles is coming soon. In fact, there are multiple pieces of data that seem to point towards the same thing. For example, the Shiller PE ratio is currently near its peak, where many of the crashes have happened. Or the Buffett indicator, which takes the number of traded US stocks divided by GDP, is also showing that the market is overvalued. And even the U-curve model is now flashing a warning sign that there's a very high risk of a recession happening. Uh-oh, crash coming soon? Well, not quite. That's because the market won't crash just like that, just because it looks overvalued or because it has reached an all-time high. In fact, what if I told you that this is perfectly normal and there's a simple explanation as to why all these are happening? And all of that has to do with productivity, which measures an economy's hourly output of goods and services. What you will notice here is that productivity goes up over time, and all that is due to technological advances which allows us to create more output in the same amount of time as compared to before. As a result, companies get to earn more money while growing faster and faster. So, just because the PE ratio and the Buffett indicator has been trending upwards doesn't mean that it's getting overvalued. But it has more to do with productivity improving over time. But what about the market hitting all-time highs and the fact that we have not seen as many crashes as in the past? Will we start seeing a mean reversion soon where things go back to how it was before? Again, not quite. That's because all-time highs usually happens when companies are doing well. For example, in the previous quarter, FactSet reported that 77% of the S&P 500 companies have beaten estimates, which is slightly above the 10-year average of 74%. As a result, whenever you get an all-time high, it will usually come in a cluster. Okay, but what about the U-curve inversion happening? Doesn't a crash always happen not too long after that? Well, yes, but no. That's because there were times when recession did not happen after the inversion, like in 1966. And while the inversion also happened in 2019, it certainly couldn't have predicted that the pandemic would happen and cause a recession. Or maybe it did predict that. The reason this U-curve inversion has happened was mostly due to the Fed raising interest rates fast and furious, which caused long-term bond yields to go up and become super juicy. But maybe let's just say it's right this time. A recession will come. But when? Historically, it can take the recession anywhere from 10 months all the way to 4 years to happen, during which pretty much anything could have happened in between, which again makes this a rather unreliable indicator to use.
So, you mean that there won't be a crash coming anytime soon?
I don't know. All I know is that I don't have a crystal ball and can't predict what could happen in the future. But what I know is that based on the data that I'm seeing right now and historical trends, it does seem like there won't be a crash coming anytime soon. Quick pause. Momo Singapore is currently offering 0 commission trades on US option every month. To enjoy this promotion, all you need to do is complete at least 1 US trade every calendar month and you will get to unlock up to 100 free commission contracts. Terms and conditions apply. Momo Singapore currently supports over 11 types of option strategies, offers real-time options pricing with customizable filters, free level 2 in-depth quotes, as well as advanced technical tools to help you analyze stock movements and discover market trends. With Momo Singapore, you will get to enjoy low commissions whenever you trade stocks, cheaper margin rates, plus with their latest tiered pricing options plan, you will get to enjoy even lower options trading fees the more you trade. And right now, they are offering some very generous promotions. You will first get to enjoy a 6.8% per annum guaranteed returns for up to 30 days on your first $80,000 invested with Momo Cash Plus. On top of that, you'll be able to unlock up to 4 stock bundles of the top 5 traded US stocks worth 70 SGD each and an Apple share worth 243 SGD, plus up to $20 cash coupon exclusive rewards when you sign up using my link. So there's $990 worth of welcome rewards in total. Holding period and buy trades applies. So if you're interested in taking your investments to the next level, do try out Momo Singapore. And with that being said, let's get back to the video. So here's the first data. Just last week, the inflation report showed that inflation has fallen for the first time since 2020. While this by itself does not mean much, what's important is that in the same month, we also saw the unemployment rates rise slightly, fewer jobs were created, and the US economy growth rate has slowed down. This means that inflation has already come down and the economy is not that hot anymore. And if the Fed were to keep rates high for too long, they might risk weakening the economy and cause a recession. This has prompted Papa Power to finally start hinting that they could be cutting rates later this year. And sure enough, the CME Fed Watch 2 is currently predicting that there's an 88% chance that we could see a 0.25% rate cut in September. And that's a good thing because lower interest rates means it's cheaper for companies to borrow money, which means more stocks and to the moon. But then you might ask, doesn't the market usually crash whenever we see a rate cut? Yes, but this is just cherry-picking data. That's because there are actually a lot of instances where the market not only did not crash after a rate cut, but instead did super well, like in 1984, 1989, 1995, and 2019. The reason big crashes happened after some rate cuts was because the economy was already in a pretty bad shape, and the Fed had to do rate cuts in order to save the economy. For example, in 1973, there was the oil crisis and the collapse of the Bretton Woods system. 1981, there was the Fed raising interest rates fast and furious in order to fight inflation, which caused the crash. Then in 2001, the dot-com bubble, and in 2008, the Great Financial Crisis. So just because the Fed pivots doesn't always mean that it's a bad thing. And in this case, we might just be in something called a Goldilocks economy, where the inflation is slowing down, unemployment rate is still historically low, and the stock market is doing really well, which makes it a perfect time to start cutting rates. The other piece of data is that this year is the US presidential election year, which first of all is typically a good year for the stock market, giving an average return of 11% since all the way back in 1928. Besides that, the bigger news of last week, if not of the entire century, is that Donald Trump, aka the actor from Home Alone 2, narrowly avoided being assassinated. But there were photographers who took better headshots than the sniper. This boosted the morale of his supporters. As a result, Trump's odds of winning the election surged to a new high. While on the other hand, the majority of the voters feel that Biden isn't mentally fit to serve as president, meaning Trump is very likely going to be re-elected. Now, whether you like him or not, we can all agree that the market likes Trump a lot, as it went up by almost 80% during his presidency. And if it wasn't for the pandemic, the return would have been a lot higher. Why? That's because Trump policies tend to be very pro-US. For example, during his presidency back in 2018, he introduced tax cuts for both the companies and individuals, which, as you might expect, is a good thing for businesses as this will allow companies to retain more of the earnings while boosting the economy. But perhaps a more significant impact that Trump will have on the economy and the markets is by introducing tariffs on Chinese goods, where during his presidency back then, he introduced tariffs of around 10 to 15% on specific Chinese goods. But now, he wants to raise it all the way to 60% tariff. Ho say bo. If this were to come true, it will have a negative effect on both the economy and the markets, because higher tariffs will not only disrupt global trade, but will trigger a rebound in inflation, which could persuade the Fed to start raising interest rates all over again and could trigger a market crash. Ah shit, here we go again. However, Goldman Sachs believes that the effects of these tariffs will be quite minor. And possibly, what's more likely is that given that there's so much money sitting in money market funds right now, and the AI hype is still ongoing, the market could continue to go up even further, and possibly into bubble territory. So then, what should we do as investors? Two things. One, avoid FOMOing into hot stocks. While it's true that most of the S&P 500 returns have came from the top 10 stocks this year, like Nvidia, data has shown that if you only focus on chasing the top stocks, your long-term returns will be pretty meh. That's because the fantastic returns usually come from the journey to the top, and not when they are at the top. because once they have reached the top, it will be hard to maintain that kind of return. Then you might ask, so if I don't buy the best stocks right now, what stocks should I buy then? If we look at the Magnificent 7, it has given some fantastic returns as compared to S&P 500 without the Magnificent 7 over the past 1 year. That's because these big stocks tend to be very cash rich and have a lot less cost of borrowing as compared to smaller companies, which tend to use debt to finance their operations. And as of last week, after the inflation news broke out, the equal-weight S&P 500 index started doing better as compared to the market-weighted S&P 500, which just means that the other companies are now starting to play catch up. So there's still a lot of opportunities for investors to look for returns, and not just in the top stocks alone. For example, in the real estate sector, utility sector, consumer staples sector, and so on, which so far have given the lowest 1-year growths due to the high interest rates environment that we are in. But of course, if you don't really want to do stock picking, the easiest way is to just buy the S&P 500 ETF and be done with it. The second thing investors should do is to avoid timing the market. Yes, you could sell your stock now and wait for a pullback before you go back in. But the problem with that is, you will never know where the market will go next. Facebook reports fantastic earnings, the stock crashes by 19%. Tesla reports super bad earnings, the stock downs by 13%. And the moment you time the market wrongly, your return will become lower than if you had just chuck thumb and do nothing. So the easiest and possibly the best strategy that you could use is just to consistently dollar cost average into the stock market. Market up, you buy. Market down, you cry a bit, then you buy more. Anyway, that's all for this video. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.